Welcome to the deep dive. Today, we're jumping straight into something critical, really the nervous system of the modern economy, the electrical grid.
Hmm.
You hear the headlines constantly, right? AI needing just uh, vast amounts of power, massive new data centers popping up,
Everywhere, yeah.
and just the general push towards electrification. These aren't abstract ideas anymore. They're creating immediate, intense pressure on utilities,
Really?
forcing them to commit billions, literally billions, in infrastructure investment just to keep things running.
Just to keep pace, exactly.
So our source material today gives us a fantastic inside look at this pressure cooker. It's FirstEnergy's strategic and financial highlights from Q3 2025.
That's right. And our mission here is, well, it's to really extract the key insights from these numbers. We need to see how FirstEnergy, and they're a huge player across the PJM region.
Right, the Mid-Atlantic and Midwest grid operator.
Exactly. We need to see how they're performing, but maybe more importantly, how aggressively they're capitalizing on this huge demand shift.
And where they're placing their bets long term.
Precisely. Where are the long-term bets going? This report, it's a really crucial window into the future of, well, American grid infrastructure.
Okay, so let's unpack this, starting with the initial scorecard. The first thing that just jumps out is the sheer financial health.
Yeah.
It seems like the foundation underpinning this massive shift. Core performance metrics look strong, suggesting, this company is financially capable.
They seem to be capable of taking on these huge multi-billion-dollar projects.
So break down those core numbers for us.
Okay, look at the core EPS growth. For Q3 2025, they delivered 0.83 cents per share.
Okay.
That's solid 9% growth over the same quarter last year.
That's pretty good.
And year-to-date, the growth is actually even more impressive, $2.02 per share. That's a 15% jump over the same period in 2024.
15%. Wow. Now, you mentioned core EPS, and maybe for listeners who aren't, deep in utility finance every day,
Right.
we should clarify why that metric matters so much. It's non-GAAP, right?
It is, yeah. Core EPS is a non-GAAP financial measure.
Okay.
It sounds technical, but basically management uses it to kind of clean up the books.
Okay.
To make sure you see the steady, reliable heartbeat of the company. It ignores, one-off financial noise or what they call special items.
Things that might obscure the real trend.
Exactly. Things that might obscure the underlying operational trend. They want you focused on that core stability.
And it seems like that core stability is driving their confidence then.
Absolutely. Because of this strong year-to-date performance, they're actually raising expectations for the full year 2025.
Oh, interesting.
Yeah, they're narrowing the core EPS guidance to $2.56 per share. That puts them right in the upper half of their original range.
Okay, so tightening it upwards. But the real long-term anchor here, I guess, is their guidance for the future.
That's right. They're reaffirming that 6 to 8% core EPS compound annual growth rate, the CAGR, stretching out all the way through 2029.
Okay, 6 to 8% CAGR. Why does that specific range matter so much in, a regulated utility world?
Well, it really matters because of how they pitch this to investors, to shareholders.
Right.
That 6 to 8% growth, coupled with the dividend yield, means they're promising a roughly 10 to 12% total shareholder return proposition.
Which is pretty attractive in a stable sector.
Very attractive. In a regulated business where earnings are, generally highly predictable because regulators approve the assets you can earn a return on, that 10-12% target is gold.
And they're hitting their marks now.
They seem to be executing well enough that their consolidated return on equity, the ROE, is currently sitting at 10.1%.
Okay.
Which is slightly above their targeted range of 9.5% to 10%. So, yeah, hitting the marks.
So the finances look rock solid. Foundation's there. But what are they building this massive confidence on? What's driving it?
Well, yeah.
That takes us straight to the explosive demand curve. That's driving all this capital spending, right? We're talking huge electrical load from data centers.
Yeah.
Stuff that didn't even exist a few years ago.
This is really the centerpiece of the whole report, I think. FirstEnergy argues it is, and they use this phrase, uniquely positioned within PJM to capture this demand.
Uniquely positioned.
Okay. And the numbers defining this demand are, well, they're staggering. They break it down into 3 crucial categories you really need to understand.
Okay, what are they?
First, there's the contracted demand. These are signed agreements locked in. It's now 3.8 gigawatts.
3.8 GW contracted. How does that compare?
That's a 30% jump just since February this year. So rapid growth and firm commitments.
30% in, 8 months? Wow. Okay, what's next?
Second, the pipeline demand. Now, these are projects with high confidence. They've secured property. They've got permits moving.
So pretty likely to happen.
Very likely. That pipeline is now at 11.7 gigawatts.
Whoa, okay. 11.7 gigawatts.
Think about that number. 11.7 gigawatts just in their confirmed pipeline alone. And this figure, it has nearly doubled since February 2025.
Doubled.
Yeah, back in February it said at 6.1 gigawatt. So the growth trajectory here is almost unbelievable.
11.7 J love you. I mean, to put that in perspective, that's bigger than the entire generating capacity of many small countries.
Absolutely.
That right there is the strain point.
It is. But the truly eye-popping figure, the one that kind of hints at the scale of the challenge facing the entire PJM system, is the third category, load studies.
Load studies, what does that mean?
These are requests from potential large customers asking FE to study the grid impact if they build. In 2025, FE receives requests for large load studies representing a potential demand of, get this, 38 gigawatts.
38 gigawatts.
38.
And that's potential demand mostly in Pennsylvania and Ohio?
Primarily, yes. PA and OH.
Okay, wait. Is that 38 GW figure even included in the 11.7 GW confirmed pipeline you just mentioned?
No, it is not. That's the kicker.
Here.
This 38 GW is entirely separate from the 11.7 GW currently moving forward.
So these are additional potential projects looking for grid capacity.
Exactly. These are requests showing the utility where prospective customers plan to build or want to build. The potential implication is just immense.
So what does this do to their overall system demand forecast?
Well, FE's total system peak demand is now expected to increase nearly 50% by 2035.
50% in about 10 years.
Yeah, climbing from roughly 33.5 GW this year to potentially 48.5 GW in 10 years. And that forecast already includes a lot of growth.
Right.
But if even, say, a quarter of that 38 GW in new studies actually materializes.
They blow right past that 48.5 GW forecast.
Easily.
Yeah.
Easily.
Okay, that brings us right to segment 3 then. How on earth are they planning to fund this necessary expansion?
Right.
Because with demand exploding like that, accelerating infrastructure investment isn't really optional, is it? It's absolutely required to avoid massive reliability problems.
Precisely. It's not optional.
Yeah.
So they are accelerating their capital plan. They've raised the 2025 investment plan by 10%.
Okay, to what?
Up to $5.5 billion for this year alone.
$5.5 billion in 1 year.
And year to date, they've already deployed $4.0 billion that, which means they're running about 30% ahead of the spending pace they set in 2024.
So foot is on the gas, financially speaking. Where's that money going specifically?
The focus is overwhelmingly on the transmission system. Think of those as the high-voltage highways that move power across huge distances.
Makes sense for large loads.
Exactly. They expect to increase total transmission investments by 30% in the next 5-year plan.
Okay, and this is where we need to loop back to the regulatory side. And this term rate base.
Yes.
This capital is being poured into the transmission rate base. We've used the term, but maybe just quickly define rate base again and why its growth is the key financial nugget here.
Sure. So rate base is essentially the value of the assets, the wires, transformers, substations, sometimes power plants, that regulators agree the utility is legally allowed to earn a guaranteed stable return on.
Got it. That's their core earning mechanism.
It is. It's their bread and butter. So
Yeah.
the 18% rate-based growth they're projecting for transmission through 2030. That means the value of these earning assets is expected to more than double by the end of the decade.
More than double. Okay.
That is the fundamental reason investors are so keen on that 10-12% return proposition we talked about.
Because it's based on regulator-approved assets growing rapidly.
Exactly. It's based on regulatory confidence that they can recover these massive investment costs plus a return.
Okay, that makes sense. But even with, $5.5 billion planned this year, and they reaffirmed a huge 2025-2029 base investment plan of about $28 billion.
Right? A big number.
How can $28 billion cover the infrastructure challenge posed by 38 GW of potential demand? It still feels like they're planning for the 11 GW growth,
Yeah.
while this 38 GW monster is kind of knocking at the door.
That, I think, is the core tension you can see reading between the lines of the source document. $28 billion is a huge figure, yes, but it primarily covers the transmission build-out needed for the known 11.7 GW pipeline.
Right, the confirmed stuff.
The confirmed stuff, plus general system upgrades and modernization. If that 38 GW materializes, or even a significant chunk of it.
Then $28 billion is just a down payment.
Exactly. We're talking about a complete reimagining of the grid. It would require tens of billions more, likely spread across multiple utilities in PJM, not just FirstEnergy.
So that $28 billion plan is really just the opening bid.
It really highlights that the $28 billion plan, while massive, is just the opening bid in what looked like a generational infrastructure expansion.
Okay, let's shift gears slightly now to regional resource planning, because these demand figures, they don't just strain the wires, they obviously require new generation.
Absolutely. You need power plants.
So what's happening specifically in West Virginia, that's where FirstEnergy still operates as a fully integrated utility, right? Generation and delivery.
Correct. And their West Virginia Integrated Resource Plan, the IRP, which they just filed in October 2025, it's basically their formal declaration that there's a capacity problem looming.
A shortage. When?
The state is projected to be short on capacity starting as early as 2027, just a couple of years away.
Okay, so what's the plan to fix that?
It's multifaceted, but the biggest piece, the most significant component, is building 1,200 millidollars of new combined cycle gas turbine generation, CCGT.
1,200 milliWs of gas. When would that come online?
Construction would start around 2027, with the new power plant expected to be in service around 2031.
Okay, wait a minute. If the big narrative is energy transition, renewables, why is the main answer here 1,200 milliW of gas generation? That's a, what, $2.5 billion estimated investment in fossil fuels.
Yeah, about $2.5 billion estimate initially.
Is this purely about reliability or politics?
I think it's a mix of reliability and, frankly, political reality. The report explicitly notes that this plan is strongly aligned with Governor Morrisey's 50 GW by 2050 initiative.
Ah, okay. State-level policy alignment.
Right, which suggests strong state support for firm, dispatchable generation, meaning power plants you can turn on whenever needed to solve that looming 2027 capacity shortfall, especially as older coal plants retire.
So gas is seen as the reliable bridge fuel there. Are they doing any renewables?
They are hedging a bit. The plan also includes 70 milliws of utility-scale solar generation.
70 milliW versus 1,200 milliW of gas.
Right. The solar is expected to be in service earlier, maybe by 2028, but yeah, the gas plant handles the bulk of the projected deficit.
Okay. So beyond generation planning, regulatory environments are always critical for deploying all this capital we've talked about.
Always.
What's the status of the regulatory runway in other key states, like Ohio, which is a huge part of their footprint?
Yeah, the regulatory calendar in Ohio is absolutely critical because that's the mechanism for recovering the costs of all these billions in investment dollars.
Makes sense.
They expect a final decision from the PUCO, the Public Utilities Commission of Ohio, on their pending base rate case sometime in November 2025. So, very soon.
And that decision is huge for them.
It's huge. Once they get that regulatory certainty, they plan to file a new multi-year rate plan almost immediately afterward.
And that multi-year plan would cover the data center build-out costs.
That's the idea. That multi-year plan will be the regulatory pathway for recovering the costs tied to that 11.7 GW data center pipeline we discussed.
Got it. Any other notable regulatory moves?
Well, we also see smaller but still noteworthy movements in Maryland. Things like the approval of an electric school bus pilot program.
Okay.
And approval of a time of use, or TOU, pilot program. It shows regulatory bodies are starting to adjust to new energy demands and thinking about managing customer behavior too.
Right, demand-side management. Now, inevitably, whenever a utility talks about accelerating investment like this,
Yeah, the big question comes up.
the public asks, how much is this going to cost me on my bill?
Exactly. And FE addresses this head-on in the report. They have specific affordability claim, which really serves as their public defense for these high infrastructure costs.
What's the claim?
They claim their bills, on average, are 19% below their in-state peers.
19% below competitors in the same state.
Correct. And they expect them to remain lower throughout this whole planning period, even with the investments.
That's powerful political cover, isn't it?
It gives them significant political runway to get these multi-billion-dollar projects approved, yes.
And when you look at the actual customer bill breakdown, especially in their deregulated states like Ohio and Pennsylvania, where does the cost really lie?
It shows where the pain points often are for customers. Generation, just the cost of buying the actual power on the market, makes up about 60% of the typical bill in those states.
60%. And that's the volatile part.
That's the volatile part. It increased about 16% year over year, according to their numbers.
Okay, so while T&D investment is happening, the biggest chunk of the bill is still the power itself.
Exactly. The transmission and distribution component, T&D, where all this new $28 billion investment is focused, only makes up about, say, 33% of the bill.
Right.
So while their infrastructure investments will likely increase that T&D portion over time, the biggest driver of recent bill increases remains the volatile cost of generating the power.
Interesting. And yet, they seem to be keeping things stable in their integrated states, like West Virginia.
They do. They highlight that in West Virginia, where they manage both generation and distribution, average residential bills remained almost flat, $137 in 2025 compared to $138 in 2024.
Basically unchanged.
Yeah, and that stability, they'd argue, demonstrates the benefit of having that integrated model where they can proactively plan for generation needs.
Rather than being purely subject to wholesale market swings.
Precisely. Instead of relying solely on volatile wholesale power markets, it underscores that investment is necessary, but maybe strategic integration provides some measure of price control for the customer.
Okay, so wrapping this up, what does this all mean for you, the listener, tracking the energy transition and grid evolution?
Yeah, what's the takeaway?
Our deep dive into these FirstEnergy documents seems to confirm a few key points. First, their strong financial performance in Q3 reinforces that they have the capability to execute these massive, necessary infrastructure projects.
The foundation seems solid.
Second, that confidence and that spending is fundamentally driven by the data center boom. That's evidenced by a confirmed 11.7 GOBW pipeline that, astonishingly, doubled in just 8 months.
It's not just a grid upgrade anymore.
No, it's a fundamental capacity expansion required for the AI future, for electrification.
Right. And that really leads to the final thought we should probably leave folks with.
Okay, what's the provocative final thought?
Well, we know FE is planning for roughly a 50% increase in peak demand by 2035 based on current growth trends and that 11.7 GOBW pipeline.
Right.
But what are the massive systemic implications of those 38 GOU of load studies? That huge chunk of potential demand, mostly in PA and Ohio, that is not even included in the current $28 billion growth plan.
The demand that's just knocking on the door.
Exactly. What level of generation, what level of transmission infrastructure investment will be required across the entire PJM grid if only a fraction of that 38 GW actually materializes in the next 5 years?
It suggests the current plans might still be underestimating the scale.
It really does.
Yeah.
The current plan is robust, sure, but the future potential hinted at by those load studies suggests the scale of the required investment maybe hasn't even been fully captured yet by anyone.
That's a fundamental question hanging over the entire utility sector.
I think so.
Yeah.
That's something to really keep an eye on as you watch this space evolve.
A truly compelling thought on the future capacity challenge. All right, that's it for this deep dive into the high voltage future of our electric infrastructure. We'll catch you next time.